Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Welcome to the second podcast regarding the Cormark-Corton Quant Fund. As usual, we'll start with the disclosure statements. I'm Mark Meriet. I'm an officer and director of Cormark Quantitative Analysis Inc., or CQA, which is a wholly owned subsidiary of Cormark Securities. CQA developed quantitative models that have been licensed to and implemented by Corton Capital Inc. Corton is the investment fund manager and portfolio manager of the Cormark-Corton Quantitative Opportunities Fund and its underlying fund, Cormark-Corton Quantitative Opportunities Fund LP, each a related issuer of CSI and Corton. So let's get to the fun stuff. Lots of clients these days are talking about gold, not surprising. And I've got a bit of a contrarian indicator on the commodity here. So what we look at, the bottom clip of this slide, where the circles are, is an oscillator. It's a momentum indicator called an RSI. Just goes from 0 to 100. And we see here that we're at extremes only visited 6 times since 1970. So what does that mean? We'll go through the signals. So the first two happened in these extreme momentums above 86, by the way, on this indicator is a 2 deviation event in 1972 and 1973. Now that was the start of a really big bull market in gold, and now we've already been in a strong bull. So we're thinking that these two are not as relevant. So the last 3 signals that we've seen were December of 1979. That happened to be 1 month before the high. The next month it went up another 27.5%, so it could still continue. But then we had a pretty significant drawdown of about 50% over the next 2 years. The other signal was in 2008 in January. That was sort of in the middle of a big bull run for gold. It did pause for about 1.5 years and had a 22.5% drawdown. And then the most recent signal was in July of 2020, sorry. And that marked the beginning of about a 3.5-year pause for gold. And the drawdown was about 33%. So gold is clearly in an uptrend, but we think it's running too hot here, and the risk reward profile has changed. And we look at the stocks themselves, the ETF, the GDX, and we can just see it's basically turned into a bit of a hockey stick. So the price in black is very extended versus its moving averages. The first kind of line of support to us is the 20-week or 100-day moving average, which is in blue. That is around $58, and the GDX is now 77. Doesn't mean it has to fall to 58 tomorrow, but it's just showing how stretched it is. And then the bottom clip is a momentum indicator called a Kopic curve. It's just a smooth rate of change. In this case, it's a weekly time frame, and that's sitting at 69%. So you can see it's like a rubber band that's been stretched pretty far to the upside. So we have been reducing gold exposure just because a lot of the stocks are strong but stretched. So that's our 2 cents on gold. Still in an uptrend, but a very frothy market here. Our usual kind of red light, green light, broad market indicators, you can see Still lots of green lights. We'll go through some of these charts, global equities, breadth, risk appetite, etc. We don't see a lot of warning signs. The one area that, from a macro point of view, that is a bit of a concern is that the 2-year bond yield looks vulnerable here to going lower. And that's a bit of a barometer for the economy. So we'll talk about that. That's kind of the key risk that we see. So starting with global equities, this is an equally weighted index of 3,000 stocks around the world. It has a much different, geographic allocation. China is 20% of this, for instance. And you can see it made all-time highs recently, and it's sort of close and holding those that breakout level. So the market's clearly in an uptrend. This index flipped in early May ahead of the S&P. The S&P itself, we had been looking for a correction, frankly. It's been kind of a straight up market. And some of the levels we were looking at were 66.50, which we just took out to the upside. We're at 67.50 and the recording here today. It's October 3rd, Friday. The next level is around 7,000. It's a cyclical bull market based on this momentum indicator at the bottom clip. This is also an RSI, but on a weekly time frame. This turned positive back in June, pushing above 60 for the first time, that green circle that you see in the lower right corner of that chart. Historically, the subsequent returns, going all the way back to 1896 for the market, are an average of 21% over the next 20 months. So it's a key kind of cyclical bull bear indicator, and we're in a bull market. Some breadth measures here. This is measuring for the S&P how many stocks are in a long-term uptrend. It's just defined by, is the 50-day moving average above the 200-day moving average. They call that a golden cross. And you can see it's kind of consolidated, but making a slight new high here, 67%. It bottomed in April at 40%. And importantly, there's further room to run. This indicator can peak out at 80 or even 90% historically. So there's more room for the cyclical bull to expand. Now, short term, we actually have had evidence of a correction underneath the hood. Here is the S&P percent of stocks above their 50-day. You can see recently it touched as low as around 50%. So even though the market is making new all-time highs, underneath the hood, there have been a number of stocks that have pulled back. Further room to expand on this breadth indicator as well. The green bars show for the Russell 3000, so a very broad list of stocks, how many are making 52-week highs. That's at 4.5% currently. When it gets north of 20%, that's generally as good as it gets. It doesn't mean the market peaks out on that day, but again, further room to run there. A warning sign I would look for is if the red bars exceed minus 10%. So those black circles that I've noted on the chart. So this is when there's more than 10% of the Russell 3000 are making 52-week lows. And so that's something we look for. Typically, there's a lot of damage underneath the hood before the market actually peaks out. For instance, the last time we saw this was in November of 2021, and then the S&P peaked in January of 22. It also happened in February of 2018, and then we had Q4 of 18, the big disaster. And then the final step as this progresses is to look for quote unquote blood in the streets when this red bar is very, very depressed. So there's more than 30% new lows. And that's where you want to kind of step in because it's washed out. So right now we're in this kind of neutral camp where the green bars, the 52-week highs, have further to expand, and the red bars are not showing any sign of weakness. Our risk appetite indicator, we call this our Baker's dozen. There's 13 risk trades across financial markets highlighted in the table there. It's been kind of consolidating, but still in an uptrend. One key risk trades that we look at is the credit market. So the red line here shows credit spreads, but inverted. And typically, not always, but typically that rolls over. Spreads start to widen. That red line goes down ahead of a peak in the S&P. And that's not happening currently. The S&P is the gray line, and the blue line is the global equally weighted index, which also tends to roll over ahead of the S&P. So both are constructive here, so no warning signs. Factors, we were a little bit surprised that beta is right back in the sunshine. It had drifted a little bit to the lower right, kind of weakening quadrant, but it snapped right back. We look at a ratio of high beta to low vol and the momentum of it, which is the bottom clip of this slide. You can see in April, it got as oversold as it did during COVID. And then we had this massive snapback, and the momentum kind of got really stretched the other way. And post-COVID, we saw a similar thing, but we did get about a 20% correction in that ratio. This time we got a little bit of a blip, and it keeps going, a bit of a slower pace, but that kind of surprised us as well. Sector rotation, cyclicals are still leading versus defense. And we like to look at this slide here, breadth by sector. In the sunshine are golds clearly, so perhaps they're running too hot is our argument right now. Discretionary has had a big move up the rankings, and that's in the sunshine. Communications as well. These are in North America, not necessarily Canadian communication stocks. Percolating in the upper left are energy and materials. So we've been adding to those areas recently. And financials are deteriorating in the lower right. We're quite underweight financials here. From a macro point of view, do we see signs of a recession? And things are slowing, but no recession yet is the conclusion. The blue line here is the hard data, as they call it, what people are actually doing, what their gasoline sales are every week, or how much electricity they're using, and so on. That's held up like a rock. Whereas the surveys, how people feel, are the red and black lines, and that would have suggested a recession back in the middle of 22. So as long as that hard data holds up, we're not calling recession. And then the labor market continues to slow. The blue line shows a basket of 8 indicators. It was super tight labor market post-COVID. On a normalized basis, this line got to 2.3 deviations above its mean. It's still 0.9 deviations above the mean, so below zero is recession territory. So yes, slowing, cooling, but not collapsing. And we mentioned at the start the 2-year bond yield. We're watching that closely. So here we show in blue the 2-year yield and in red are the Fed funds. The Fed just cut by 25 beeps recently. And the 2-year in blue is still 75 basis points below the Fed funds rate. So the market really dictates the Fed to me. They drive the bus. The 2-year turns up and down ahead of the Fed funds rate. And you're kind of treading a fine line here. So the red bars show when the 2-year yield falls below the Fed funds, they start to cut, and the red bars show recession outcomes and the green non-recessionary outcomes. And it's a coin flip, frankly. Since 1980, there have been 4 recessions out of those 8 instances when the Fed cuts. And the outcome for the market, as you can see from the bottom right of the table, is very different. 18 months out, a recessionary outcome is -8%, and a non-recession is +36%. So obviously diverging outcomes there. We don't want to see that 2-year yield collapse is the takeaway. So here again, we show in red the 2-year yield. In blue is another kind of the stable labor market indicator. It's the prime workforce age for the employment population ratio for the prime workforce age of 25 to 54. So that blue line is flatlined and hasn't called a recession yet. If we see the 2-year yield really falter, and that would suggest, the Fed may be behind the curve, and the economy is getting a lot weaker. So that, to us, is one of the biggest macro risks out there. We're monitoring it, but so far the Fed has started a cut. And then the message from Mr. Market: if we look at equally weighted discretionary to staples, people say, this is what people want versus need, and it's an excellent strategist, if you will, just looking at this chart. and it's pointing up. Recently made new highs. You can see that it deteriorates well ahead of a recession, which are the red bars. You don't always get a recession when the market is in trouble, for sure. We didn't get one in 2022, for instance, and this line went down and it was a vicious bear market. But the chart in front of us is still quite constructive. So that's the market outlook. In terms of our fund, we have exposure. The top left shows sort of by broad category. Resources were overweight, about 1.7 times the index weight. Also overweight industrials, tech, and discretionary. We kind of bucket those three sectors. Defense were around neutral. Think about utilities and telcos and staples and so on, healthcare, REITs. And financials, we have a quite a light weight here. And in general, we'll be underweight the financials because we're not going to, we don't want to hug the index, and the banks, for instance, are 20% of the market. And insurance stocks, which have been very, very weak of late. We did have some exposure several months ago. We don't have any insurance right now. We have 7% roughly of short positions of individual names. We've started to short names here recently as the market is kind of getting a little more bifurcated in Canada. Cash, we have 5%. Our beta is 1.1 and a very high active share at 95%. Small to mid caps represent about 3/4 of the fund currently. And again, we have reduced gold exposure quite dramatically. We had about a 23% weight in gold, which is almost double the benchmark. That's our risk parameter. That's the max weight for us. And just given the poor risk reward, I'm not saying gold has to go down today, but the stocks are kind of out on sticks here. So we've been deploying that into things like base metals and industrials and some energy names. So back to this active share idea, if you think about this Venn diagram of the fund versus the TSX index, 100% active share would mean you have nothing to do with the index, whereas 0% is you're basically an index clone. We're aiming for high active share through long short with variable net exposure, lots of small to mid caps, big sector bets, and so on. So we're sticking to that concept. Here are some screens of where we hunt for names. Quant stars on the left. You can see lots and lots of gold stocks there, with the caveat that they're again overbought, and value names on the right. We also look at our rotation, our sun rain chart for stocks, both for the 100 and for the whole universe, frankly. And we can see in the upper left, there are base metals and energy names percolating in that improving camp. A few recent trades. We've added a few weeks ago some REITs to our fund, both office related, people being mandated back to work and so on. That should help the vacancies. These are value picks for us, both Allied Properties and Dream Office. And the clean energy theme has turned around. On the right is the ETF ICLN relative to the world. Massive downtrend has been reversed recently. We've added Northland Power a few weeks ago. And then, as I said, reduced golds, just purely based on the fact that they are very strong, but stretched both in terms of momentum and relative to their support levels in terms of their moving averages. And we have one short example here, a value short. It's an expensive stock on our work, and it's recently broke down the TMX group relative to the market. So last month, our biggest contributors were Kraken USA, which is a silver name, and Zedcor Industrial. And then we got hit with GoEasy, MDA, and Descartes. The performance is shown here, again, very early days. September, the gross number was a little over 8%. The TSX returned about 5%. So that will be a good month to add to the ledger. And we'll leave it at that. If you're interested in the fund, reach out to myself or David Jarvis, who is the founder of Corton Capital. His contact is listed here. And thanks very much for your time.